Firstly, I would say, the margins are in line with what we had planned. So it's not a surprise. We believe the year has been very strong for us. Our LTM Y&Y growth has been 15.1%. Our investments in what we believe are fundamentally shifting the market are going in the right place, and we are, pretty confident of their delivering to the strategy for what it is.
Okay.
So whether it is, let's say, increased rehiring of people in large-scale deals, right? We talked about engineering services outsourcing, right? Which is kind of, they are engagements which is moving more full service, which requires us to do the end-to-end engagement before they move to steady state and the margins improve, right? Similar to the infrastructure business of what we saw in 2009-10, and we've successfully demonstrated how you can take money out of that as the engagements move into steady state. So that's one reason. The second is, I think, the whole concept of investment in co-innovation labs, investing in a talent profile which will drive some of the transformational engagements going forward in digitalization, also chips into the margin, is the investments which are coming about there. So largely these three things. Other than, I would say, maybe from a quarter perspective, a higher outflow on visas, which is a seasonal parameter, so that is what we saw in the previous quarter.
Okay. So in that case, Anil, can you give me a breakup of the margins for this particular quarter? And typically, I remember last quarter you had indicated that you want to maintain the 21 to 22% margin band. Is this one quarter a one-off? And from next quarter onwards, would you be able to cross that 20 or rather stay within that band?
So the band is for the year, not for the quarter.
Okay.
And this is what we have been saying. Always look at our margin on a last 12 months basis.
Okay.
So we are very confident that for the next fiscal year, we will be able to, July to June basis, we will be able to maintain the margin is 21 to 22% range at EBIT level.
And this quarter, can you give me a breakup of the margins? What has been the exact impact of visa cost and the increased investment? And of course, there would be some kind of a positive impact owing to currency?
Yeah, so we had a positive impact on account of currency, you're absolutely right, of 40 basis points. At the same time, we had negative impacts of visa cost, as Anant explained, of about 60 basis points. And we had higher SG&A of about 70 basis points. And our continued investments, which are there in nearshore delivery centers, and hiring talent for digitalization, hiring talent for risk and compliance. Those areas adding up to another 100 basis points.
100 basis points. Okay, so in that case, going ahead, Anand, what's your outlook with respect to investments? Will you continue to, or rather, when would these investments start bearing fruit in terms of pure play margins level? Because of course margins are getting impacted, and you said that you would rather take the risk of margins getting impacted, and you'll continue to invest. But by when will the investments gradually come down, and we will actually see the impact flowing into the numbers?
So like we said, right, we will be in a guided range of 21 to 22 for the full fiscal. So we will focus on delivering the margin within that range, right? So there will be some engagements which will deliver in one quarter, some will move in the second quarter, and so on. But I think from a full fiscal perspective, we believe that we should be able to execute to that, the range that we've talked about. I think, we should look at some of these from a little longer term perspective. And some of these will really, mimic the way fundamentally the market is changing. So digitalization is not a line item on its own, which is suddenly coming today, right? Digitalization has been there for a while. The nature of that engagements are shifting, right? Digitalization has been there in infrastructure, is there in engineering, it's also there in modern applications that we do. But the way we look at the market going ahead is a kind of an innovation along with our customers in building some of the transformational programs for the future. They will take time. So if you look at, we added about 47 customers in the year, which are a little over $1 million plus, separate from the customers in the large deal, 30, 50, $100 million. Now those customers are on a journey. They will work on small programs before they move into mid-size and large engagements. And they're not going to happen overnight. They will take 1 year, 2 years, 3 years, and each one of them will be in a different phase over there.
Okay, so the increased investment, if I'm correct, will continue for this entire coming fiscal?
Oh, absolutely.
Next. So then by post FY16 is when you're saying we'll actually start seeing that increased margin outflow. Am I correct?
Different. So yes, digitalization, we should see a longer horizon. If we look at some of our investments in large-scale engagements like engineering services, they will move into steady state a little earlier than the end of the fiscal itself. So I think they should translate into a better margin trajectory. But I think it's a little unknown at this time how digitalization will pan out. So it could very well be possible that some programs move faster than others, in which it would be a surprise, a positive surprise as well.
Okay. And let me ask you about the overall deal win trajectory. For this particular quarter also, you've crossed about $1 billion. For the full fiscal, around $5 billion. Q4 typically is seasonally weak when it comes to Q-on-Q deal wins. Have you seen that impact? And can you break up the deal wins for this particular quarter?
So Anant will be able to give you much better sort of a perspective here. But as per one of the reports of one of the analysts, ISG, basically saying that in the next 6 months, the deal signings will be more stronger than in the first half. Yeah, so I would say that there's a huge pipeline is significantly has increased over the same period last year.
Okay, Anand would like to add
so I think, Sonal said right, the pipeline as we see today is larger same period last time. If you just look at, I would still say that there are some very, very large programs which will potentially shift into H2. If you look at last year, we had significant number of bookings in the $100 to $300 million deal range. Previous year, we saw a couple of deals in the $500 million plus range. Last year, we did not see that. As we look at our pipeline, we believe there are a number of them in here, but I guess some of them will go into H2 from a decision-making standpoint. I think it's also important to really look at how does this all translate, right, at the end of the day from a growth rate perspective. So if you look at Americas for us on an LTM Y&Y basis grew by about a little over 14%, which is industry leading. If you look at Europe, that grew by 18% on a constant currency basis. So I think
Europe on a quarter-on-quarter basis has been flat in this particular quarter. Is that because of the one-off that we are seeing in this quarter, and do you expect that to stabilize going ahead? Because some players have expressed concern that in the next 1 year it will be slightly different.
I think we see a very strong pipeline in Europe as well. So I would say the quarter is more backed by 2 previous quarters of very high growth. So I wouldn't say there's anything else. It's a one-off. Europe has a very strong pipeline, and like I previously commented, there are markets which will open up, like Germany and France. We completely believe those opportunities are there. So I think that market will definitely move in that trajectory, right? 18% performance on a Y&Y basis is industry leading. If you look at some of the sectorial performance, consumer services, retail, CPG grew by a little over 25% for us. Again, industry leading. If you look at financial services, grew by 16%. So I think there is a positive momentum in the market, some driven by churn and some driven by the emergence of a little bit of digitalization coming in as pilot programs over there. As we see some of this translate, we should see a lot more growth going forward.
Okay. Anil, a quick question on pricing in that case, because there's been some indication that pricing pressure is likely to come about in the second half of the fiscal specifically, and some players are already experiencing pricing pressure. Has that started impacting numbers? How has pricing been in this quarter, and what's your outlook going ahead?
I think the pricing in the ITO, particularly deals, is more around providing a solution. So it's a solution-based pricing rather than just the unit pricing, I would call it. I think so far as Hcl strategy has been concerned, to sort of make automation at the center of the whole ITO deals. So our execution has been led by automation. As a result, we are able to offer very competitive pricing so far as our customers are concerned.
Okay, management of HCL Tech sounds quite positive, at least in terms of the guidance going forward. They have mentioned that 21 to 22% margins should be maintained going forward, despite the little bit of disappointment that came through this time, and the Europe pipeline looks good. But more on